Hi, Martin Turner here. This week we turn to management accounting as we look at understanding key cost relationships and how we use cost objects to help us do this. We then look at period and product costs and the importance of this key distinction in the costs of our firms. And we look at direct and indirect costs and how these are allocated to products. Let's start with looking at cost objects.
Hi, Martin Turner here, and welcome to our Week 8 lecture for ACT 11059, Accounting, Learning and Online Communication, Understanding Key Cost Relationships. In this class, we're starting our look at management accounting, which we'll do through to the end of term. Management accounting will generally be simpler and less complex than financial accounting in the first half. So what are we looking at? We're going to be, first of all, looking at a key concept with management accounting, cost objects. And this is the key to understanding cost accounting in management accounting. And then we'll be looking at period and product costs, a key distinction in accounting for us to clearly understand. And then we'll have a look at direct and indirect costs, and also be introduced the accounting systems that we can use to allocate direct and indirect costs to products. So if you could hop onto Socrative and answer this question. Why is so much effort put in by managers into managing costs? Why is it all so complex? People read the chapter on management accounting material and they go, wow, it's just so many terms, so complex. Why is so much effort put into managing costs by managers? Why is it so complex? So hop onto Socrative. Oh, I've got one response. Derek in Brisbane. It is important for managers to have an understanding as to how the business is operating. That's right. There can be a lot of costs in a business. Ryman Healthcare has well over $1 million of costs every day of the year, including Christmas Day. And you can have a lot of operations everywhere. Ryman Healthcare has a lot of retirement villages everywhere, a head office in Christchurch, and all these retirement villages as well in Victoria. How do you keep track? How do you keep track of what's going on in your business? Any other thoughts people have? Why is so much effort put in by managers into managing costs? Why is it all so complex? Anita, to enable managers for understanding costs in order to make profit or keep the business running. Profit equals revenue less costs. So we've got to keep an eye on the costs if we're seeking to make a profit, because if the revenue is not greater than the costs, we're going to get ourselves into trouble over time. And to keep the business running, so the costs, we only incur costs because we think it's going to support the business to make more revenue than the costs overall that we're expending. So it's a part of making profit. We have to look at revenue as well, but costs are part of making profit. Sophia in Brisbane, managers put so much effort into managing costs because they don't want the big boss, body corporate, to be annoyed that they are spending more than they earn. Well, that's right. If your costs, it's a bit like Anita's comment. If your costs end up being more than your revenue, it's not going to be good. Or even if the profit's not big enough. Financial management is important for business cash flow. So it's certainly the costs. There's cash going out to pay a lot of costs. I mean, we'll be looking at those sort of issues later on in a few weeks. So we've got to keep track of how a business is going. It helps managers to understand what's going on in a business. Yep, that's just another way of saying it's an important part of a business. But why is it so important? There's lots of things going on in the business. Why do we put so much effort on costs? Well, when you're running a business, it's full of people spending other people's money. You've got all these employees everywhere. Home healthcare's got a lot. All these employees everywhere, and they're spending other people's money, not their own. And 99% of people will spend other people's money differently to the way they spend their own. Not everyone. Some people are more careful with other people's money. But most people, when I had teenagers, they would, they could have the heater on and keep the window open or whatever it was, and they could just use costs because they didn't care. They weren't paying for them. And but it was only when they left home and say went flatting that suddenly they get their electricity bills and they go, wait a sec, we've got to look at it. So because businesses are full of people spending other people's money, and a lot of people can feel like because it's not their money, they can spend it a little bit more readily than if it was their own. Then, if a firm doesn't keep a tight look at its costs, a tight control on its costs, they will inevitably get out of control. People will start spending money, and so you've got to keep a really good eye on the costs. So this is a key reason why they put so much effort into it. And the way we do that is complex. There's a lot of terms, and we'll be looking at, we're just introductory, but we'll be looking at a lot of terms and introducing you to this world of keeping track of costs in a business. Now, the key concept you need to be clear on is that of cost objects. It's not cost objectives. Some people seem to call it cost objectives. It's cost objects is the term. And what cost objects are, they're any aspect of a firm where managers want to know its costs. So it could be anything. It could be a product or service that you want to know the costs of. It could be a business process, such as the cost of sending out invoices. It could be the cost of a particular aspect of business, like what's the cost of a shop, and you want to know perhaps its profitability with its revenue as well, but the cost of a shop or the cost of different aspects of business. So those aspects that the managers want to know the costs, they're the cost objects. And the cost objects is where we attach costs to, because we want to know what they cost. And the same cost might be attached to more than one cost object. It might be attached to a product or service, might be attached to a customer or a business process. It might be attached to a specific aspect of business like a shop. So the same cost could be attached to more than one cost object. But you need to be very clear on what cost objects are. They're any aspect of business where managers want to know its costs. And we'll be focusing on products as a cost object, but they could be any aspect of a firm. So let's have a look at the second question in Socrative. Why are cost objects an important cost concept in management accounting? Why are cost objects such an important concept in management accounting? Anita said a bit of overlap to question one, but cost objects can break down to direct and indirect costs. Direct costs are usually easy to identify, and we need to understand indirect costs, hidden costs that may affect the business. So you're sort of skirting around the question, Anita, but you're saying cost objects is where we allocate costs to, and we're going to see it in a little while that we allocate direct and indirect costs to products, and that there can be a lot of difficulty in allocating indirect costs to cost objects such as products. But so why, it's sort of skirting around the issue slightly, Anita. Why are cost objects important? Keeping costs under control is an important element to successfully manage a business. It is. And if we don't do it, they'll tend to get out of control. And cost objects is how we keep costs under control. Cost objects are any aspect of business we want to know its costs. So say it's a product. We want to know the cost of that product. So it's a cost, we make it a cost object and we attach cost to it in various ways. May said to overlook everything. That's right, there's a lot of complexity in business. And so how do we figure out what it costs us, say, to buy or make a product? It's important for a range of reasons. How do we know what to sell our product for if we don't know what it costs? We might be selling the product for less than it costs, and that's a pretty short-term business activity, unless we have some other reason for doing it. But and the same with all the other areas of costs. If we want to control and manage the costs in our business by attaching cost to cost objects, different aspects of our business, we can focus in, say, on a shop, on a business process, on the cost of a customer, all these different things to help us make decisions and manage the business to maximize profit. So that's why they're an important concept in management accounting. They're the key idea we have in terms of controlling and keeping track of costs in any business. Now, Teo Bach is a past student of this unit. And when she was doing the reading and trying to understand for herself and make her own, because there's all these different concepts we're reading in the material, what does it all mean? How does it hold together? She did a chart to help her understand it. And this is how Teo Bach viewed these various cost concepts. Costs for the firm up the top, all the costs of the firm can be broken into product and period costs. And then we can break up the product costs into direct and indirect costs. And then under that, there's various ways of allocating direct and indirect costs to products. So that was how she was viewing these various concepts. That was her this is how I'm trying to understand it. So she broke everything into product, all the costs, Teo was saying, break into product and period costs. So what's the difference between period and product costs? What is the difference? And if you can, give an example of period or product costs from your own firm. So let's have another look into Socrative and see what you've got to say. What is the difference between period costs and product costs? Are they the same thing or are they different? How are they different? What's the difference? And if you can, give an example of period costs or product costs from your own firm. While you're doing that, I'll give you some examples of period and product costs from Ryman Healthcare. Ryman Healthcare has very little inventories, very, very low inventories. So it doesn't have a huge amount of product costs that's attaching to those inventories. And it doesn't have a footnote to its inventory, so it doesn't give any detail about what it's doing. But you could say that it's selling some products at the coffee shops and bars on its various retirement villages. So it would have some inventory to support that. And also perhaps it might have some medical products that people use that it might have in inventory as well. So it would have some product costs in some of those areas. Some costs that's attaching to those products. And its period costs might be the salary of the chief executive officer, the CEO. It's unlikely that they're attaching any of that person's costs to any of its products, and that they'll have a whole heap of other costs that it's not attaching to the products, which would be its period costs. So Derek says period costs are indirect costs that cannot be specifically pointed to a cost process and is allocated at the end of a term. Product costs are any cost that can be specifically allocated to a process, e.g. product costs could be labour, period costs could be the process of creating an item that is not identifiable until completed. Sort of sounds, Derek, like you Googled it or something. Now, period costs are not indirect costs. They're completely different concepts. We're going to look at what indirect costs are. A lot of period costs are also indirect costs, but not necessarily. So we'll look at indirect costs in a minute, but what are period costs that cannot be specifically pointed to a cost process and is allocated at the end of a term? Yeah, we're going to say at the end of a period, they're period costs. We assume for period costs that they used up in the year to make revenue for that year. So the CEO's salary, we just assume that whatever we paid that person, that has supported the revenue of that year. And product costs are those costs we attach to products or services. And period costs are for business activities and product costs are for pre-production. Example from Macca, product costs, equipment, period costs, rent. Product costs, equipment, period costs, rent. All costs are for business activities, mate. When we do stuff, we incur costs. It just happens. So it's not period and product costs. It's all activity. And product costs are not just for a production. We could just buy things. Shops, they've got their product costs are the costs it costs them to buy it, maybe to transport it, whatever they're allocating to their products. And we can allocate costs to services as well. So May's company's Macca. So equipment costs, if their products are Macca's not Macca's, it's a mining services company, isn't it? So if it's providing certain services to a mining company, which is involving use of some heavy equipment, then those equipment costs, it would definitely be allocating to the cost of those services that it's providing. So that's a good example. A period cost might be rent. Rent's often a period cost in that we just assume it's supporting the business for that period that we're paying the rent. And of course, there can be some circumstances where a different company might allocate it to products. And Macca may even do that for some of its services, but it's a typical sort of cost that might just, we assume it just is spent in order to make revenue for the period. Anita, period costs relate to current costs. All other costs to the business, product costs, costs are attached to product service for CellNet. Period costs relate to current costs. The best way to think about period costs is they relate to costs that we will be expensing in the period. We'll be talking about the difference between costs and expenses in another week. But the costs we incur them, but we don't recognise them as an expense until we are going to match them to the revenue of that period. And so for period costs, we recognise them as an expense in the period. So in that sense, if you think of them as current costs, they're costs that we're going to treat as expenses in the period. Product costs are we're going to only treat them as an expense when we sell the product, which might be in another period. We're going to connect them to the product. They become an asset, our inventories. Only when we sell the inventories do they become a cost of goods sold, and are treated as an expense. So that's a key distinction between period and product costs. CellNet, Anita's company, product costs could be the cost of lifestyle accessories packaging. That's right. So if you're selling these various accessories and you've got various packaging costs with them, you're likely to be attaching them to your product and treating them as an expense when the product is sold. And the period costs pay for designers who create the products. Yeah, we're likely, we may or may not, but we're likely to expense that each year and not attach it to any products because we don't really have them yet. We're still creating them. And so there's some good examples, Anita. They're great, actually. So what is the difference between period and product costs? Product costs are all the costs attached to a product or asset. The product is an asset. An expense, it's inventories. And they are expensed in the income statement when the product is sold. This is the key aspect of a product cost. You've got to understand there's a difference between an expense and cost. all costs attached to a product is the product cost. So if we attach whatever cost, it could be anything that we decide to attach to a product, it's a product cost. And it becomes an asset when we attach it to a product. It becomes inventory, it's an asset. We're expecting to get a future economic benefit from it. There's the possibility of that, which occurs when we sell it. An expense in the income statement when the product is sold. So the product costs don't become an expense until the product's sold, which may be in a different period. Period costs, the costs relate to the current period. We treat them as expenses in the current period. We assume they generate, the revenue they're generating is in that period. Whereas for product costs, the revenue they generate is when they sell the product, which might be in a different period. There's a key distinction between period and product costs. If you understand this distinction, you'll be starting to understand how accounting works. It's an important distinction, and you need to be precise and clear on this distinction. And this distinction is important in two areas: the valuation of inventory and asset. The more costs we put into products, the more we'll have sitting in inventory, and also the determination of profit. And we'll talk a bit about that later on in the coming weeks. So that distinction is, it's a judgment as to whether we put things into period and product costs, but those judgments can have an effect on the value of our inventories and on the level of profits for a period. So it's an important distinction. So Theo Bark saw the cost of a firm being either product or period costs, and we've had a look at that distinction. We either attach the cost to products or we treat them as an expense in the period. Now, with product costs, Theo said we can divide them into direct and indirect costs. All our products, direct or indirect. So what is the difference between direct and indirect costs? What is that difference? Well, the direct costs, the link of the costs to the cost objects, the link to the cost objects is clear and obvious. You can think of them as Bart Simpson costs. Bart Simpson would know, everybody would know that that is a cost of that product. So you might be a shop and you might have just bought, 10 iPhones. The costs of buying those 10 iPhones is a direct cost. Or you might be making something in your firm, and you might be having some material costs that you're going to turn into something, and it's clear that those costs relate to that product, the direct costs. And the indirect costs is where the link to the cost objects is less obvious and requires judgments. So there are a lot of costs that we do allocate to products or services where it's not quite so clear. It's not, in other words, different people might allocate the costs a bit differently because there's judgments involved. So that's the distinction between direct and indirect costs. So direct costs, that's simple. Everybody will allocate them the same way, basically, it's obvious. But indirect costs require some judgments, and the allocation of the direct and indirect costs, we have various systems to allocate costs. And one is the job costing and process costing methods. So what is the difference between job costing and process costing for allocating direct and indirect costs to products? Well, job costing is where we allocate costs to a specific product or group of products as we're making them. You can think, for example, you might be building an ocean liner. It's very clear that all the costs that are going into making this ocean liner relate to that one product, the ocean liner. And we can attach the costs to that ocean liner, and that would be job costing. Or we might be making a few very similar products, perhaps half a dozen, sort of specialist cars of some sort. We might make a little batch of them, and then we might allocate the cost to that little group of products. But in those manufacturing processes, the same thing applies to when we're creating services too, but we'll look at products because they're simpler to think about. When we're allocating, when we can see the product right from the beginning, there's this, we're building an ocean liner, there's the space. The first thing we do, we know it's going to that particular ocean liner. We'll use job costing, and that's to allocate both the direct and the indirect costs to that product. However, there are plenty of situations where we can't see the product during the manufacturing process. It's all mixed up with other products. It's only towards the end of the process that the products actually emerge. In those situations, we use process costing. Examples of this might be making chocolate. You're putting all the stuff into these vats. We don't know we don't know which products are coming out until towards the end. Or oil refining. There might be different oil's going to be coming out, different types of oil products coming out of the oil refinery, but they're all mixed up at first, all in this process going through. And so we can't see the products. We can't attach the products to specific products or groups of products when they're all mixed up. So we use process costing. This is where we allocate costs to a manufacturing process and then to products. And we discuss the making of chocolate in the reading. So you can allocate the cost to different processes in making chocolate. And then only then, once the products start to emerge, those costs that we've allocated to processes can be allocated to the products as they come out. The key thing about job costing and process costing too is that these are methods to allocate direct and indirect costs. So that's how there are two sort of approaches we can use in doing that, depending on the processes of manufacturing the products or the services that we're providing. So Taya saw all the costs of the firm could be broken into product period costs. The product costs could be broken into direct and indirect costs. And two approaches to allocating both direct and indirect costs was job costing and process costing. She then saw the two approaches for allocating indirect costs, the activity-based approach and the functional-based approach. And so activity-based costing is where we identify activities in our firm. And these are activities that use indirect costs. And then we measure the costs of these activities and then attach the costs to the extent a product uses that activity. Now, in Ryman Healthcare, it's got various aged care facilities. And so in these aged care facilities, they do various activities. They might feed residents or make beds, or they might take residents on excursions. So they've got all sorts of activities. There's been a lot of activities going on. And in the activity-based costing system, we measure the costs of these different activities. So to these activities, we attach staff costs and various other costs, food and electricity, all the sort of costs that are indirect, that sort of relate to the costs of running this aged care centre. We measure the cost of these activities by attaching these various costs to that activity. And then we might have various products in the aged care centre. We may have different care packages that our residents buy. For example, some might include excursions and some not. Some might include being fed, and others can feed themselves. In terms of excursions, some people may not want to go on excursions or not be able to, and so on. So then we can attach the costs to those activities. We can attach the costs to each product to the extent they use the activity that we've measured the cost of. So that's the activity-based costing system. The other costing system Thais has in her chart is the functional-based costing system. This is where we assume or estimate a functional relationship between costs and how they're incurred. And here we've got the total overheads of a department divided by the level of activity. So we may have an aged care centre, that might be the department, an aged care centre in one of Ryman Healthcare's retirement villages, and it may have a whole lot of overheads in that department, all sorts of costs. And then we divide those total overheads by a level of activity. So it can be a range of different things, but here's some examples. It was a factory, for example, machine hours, with direct labour hours, direct material costs, direct labour costs, numbers of activity measures. So, for example, in one of Ryman's aged care centres, the total overheads of the department might be $500,000. And the total direct labour hours, one of those activity measures, may be 50,000 hours in whatever period we're looking at. So 500,000 divided by 10,000, that's $50. So we divide 500,000 by $50 by 10,000 to get $50. And so $50 per hour per labour hour that we use. And then we can look at the various services or products we're delivering in the aged care centre, and we can cost them based on the number of direct labour hours they're using. So that's the functional-based costing system. So there's the beginning of introducing you to some of these key cost concepts in management accounting. What was the most important thing you learned today, and what questions still remain unanswered? Hop on to Socrative and we'll have a look at this. What was the most important thing you learned today? So just as you're putting in your responses, Anita has said the distinction between product costs and period costs. Anita, why was that the most important thing you learned today?
Because costs are very important in a business, but there's many types of costs, and that's why we have to understand what sort of costs when we determine a business to keep going.
Yes, you'll be able to think about this a bit more in the coming weeks when looking at management accounting as to why this distinction is so important. We're just introducing the concept at this point. But it's a fundamental distinction, and there are judgments involved in deciding whether a particular cost will attach it to the product or whether we'll expense it in the period. And those judgments between whether we put them into period and product costs can affect the cost of our inventory and also our profit for the period. So it is a very important, and we need to understand that distinction. And that may be something that takes a little while to really cement in as we go through looking at management accounting in the coming weeks. But that's good. May, having a better understanding of the cost concepts. Yes, and so we looked at cost objects, and that can be any aspects of a business. We're focusing on products. We're going to be focusing on products, but they're only just one type of cost object. They're a very common one, because how can you sell products or services if you don't know how much they're costing you? That could be a recipe for failure if, because how you're setting your prices and how you're managing your costs. Because you may have to just charge whatever you can in the market, and you can't sort of increase it or as you like. So then you've got to manage your costs within that constraint. And so how are you going to do that if you don't know what costs your products or services are taking. Derek, understanding how costs are broken up into various categories. Yeah, this is great. This is how Teo Bach looked at it. And, as a first-year accounting student trying to make sense of this, you see, as you try to make sense of it, having a bit of a framework can help. And this is how she made sense of it. And that can be helpful for quite a few people to think about the costs like this. And then you understand that there is a difference between period and indirect costs. Well, indirect costs are a product cost. They're attached to the product. Period costs are not. And we'll be talking a little bit about terminology and the use of other words that creep in, that are used, and we'll talk about that coming weeks. Joseph from Gin, that nearly anything in a firm can be considered a cost object. That's right. Well, everything could be considered a cost object. If we wanted to know the cost of everything, we could, in theory, probably have a crack at it. But of course, there are costs involved in attaching costs to cost objects, and all the accounting. It costs money to employ people to do stuff, and it can be quite difficult to attach costs in certain situations. So there's a sort of cost-benefit decision that goes into this. As to whether we consider something a cost object. We might want to know the costs of it, but it may not be that important, and it might be very expensive to attach all the costs to it. It might be a bit complicated. But where something is very important for us to know the costs, like a product, but lots of other things can be too. Lots of business processes, all sorts of things. Whatever we want to know the costs of, if it's important enough, then that can justify whatever it costs us to do it. But yes, Joseph, that's a good insight. Sometimes people wonder what a cost object is. Well, it can be anything. It can be a product or service. It can be a business process. It can be a customer. It can be some physical part of the business. You might want to know the cost of a factory, or some part of the factory, or some process within the factory. Or you might want to know the cost of a shop, or some processes within the shop. And that's great. So we're just introducing these concepts. What questions remain unanswered? Anita, how to judge an indirect cost in the business? Is there any right and wrong judgment? Well, there is a lot of scope for people to make judgments here. So it's not illegal to put something in here or in there. There's some scope around what you can do for indirect costs. And we'll be talking about that a bit later on. The key thing is to realise there are some judgments involved in allocating indirect costs, which means the indirect costs could be allocated differently depending on how you make those judgments. Is there any right and wrong judgment? Well, the ethical issue for accountants generally is all these different judgments we make in accounting should be made based on trying to help people better understand what is going on in the business. So if we're making judgments between product and period costs, we should be seeking to make those judgments in a way that helps the accounts better reflect what's really going on. There's all sorts of judgments, assumptions. It's never going to fully reflect exactly what's going on, but to help it be better. Or are we making these judgments because we're trying to dress the books up and make them look good? Again, we'll be talking a little bit about that. So in that sense, there's an ethical issue around it for accountants. And there is also, it can also just be unclear. There's a lot of shades of grey. Indirect costs are difficult to out. There's some judgments involved. The reason there are judgments is because it's not totally clear. So in that sense, different people can make different judgments perfectly validly, and both trying to clearly show what's going on in their firm in terms of this allocation of costs, and helping the business to be able to make good decisions. So, yeah, that's the sort of thinking. And so, the way we allocate costs to a shop, indirect costs might then affect our decision about whether to close it or not. We've got the revenues, they're generally pretty clear for a shop, but, the indirect costs and other costs and how we allocate them can affect how we make decisions. So in that sense, accounting can create reality and not just reflect it, because it can affect the way we make decisions. Derek, further explanation of how to distinguish between product costs and period costs. Direct and indirect is understood, but within indirect costs, it is further broken into categories. Yet there's more to come. More to come. It will be, how do we distinguish between product costs and period costs? Well, the key distinction is if we decide to allocate a cost to a product, it's a product cost. If we decide how to allocate a cost to period costs, it's a period cost. That's the fundamental distinction. But you're saying, when we're making those judgments, how do we tell the difference? Well, I'll be sort of closing the loop on that in a few weeks and giving you my perspectives on it. But we're going to be exploring it a bit, and you can see the way sort of Teo Bark is sort of breaking things up. You can break them up, but there's sort of a bit of shades of grey in between these categories. And some indirect product costs will be more obvious. So we might, if you take the manufacturing example, which just helps because it's all physical and you can see it, the various indirect costs we allocate to different parts of that manufacturing process. Say we're using job costing and we're building an ocean liner. Those costs that there can be indirect costs that we're attaching to that manufacturing process. It's sort of easier. It's easy to see that they're product costs. But then there are indirect costs that aren't quite so, they become more and more disconnected. The CEO's salary is a really good example. The CEO's salary, how do you tell how much of that CEO's salary should be allocated to making this ocean liner? Because the person's trying to labor stuff. So who knows? That's so people tend to make that a period cost. If you're running a Tesla factory and the CEO decides to stay in the factory for a year, sleep on the floor and just work on this factory and nothing else, then you might decide to make that a product cost while he's doing it. But so it's a judgment. It's about whether you think that cost would be better reflected in the product cost and only expensed when we sell the product, or whether it's just too difficult to allocate to a product. It's so indirect that allocating it would just be almost meaningless. You'd be making judgments, but it's just too difficult. So anyway, keep thinking about that. I'll be closing the loop on that in a few weeks, Derek. But keep watching that space. So there's some interesting questions people are thinking about. That distinction between period and product costs is often, and also what cost objects are often key things that people are picking up at this stage. And then how we do things is often the questions remaining unanswered. How do we make judgments between period and product costs? How do we decide about indirect costs and allocating those? They're things we'll be looking at more in the next couple of weeks, along with other things on management accounting. So today we've looked at cost objects. Cost objects are any aspect of a business. They can be, we're going to focus on products or services, things that we sell, products or services. They'll be our focus, but it can be anything. A business process, it can be a customer. We might not know what it costs us with this customer and how much revenue they're bringing. And we might want to know the costs of a business process, like what's it cost us to do invoicing? And should we outsource it to somebody else that are charging us less to do it? So cost objects can be anything. And management can decide to allocate costs to anything they like to find out what it costs. But it costs money to do all these accounts. So there's a cost-benefit judgment about, some things don't really matter whether we know the costs very much. So why spend a lot of money finding out? But some things you might be really worried about. You might be really worried that, the costs are getting out of control in this particular retirement village or something. You might have been there and there's some things are ringing alarm bells. So you want to know. Let's go and find out what it's costing in certain aspects of that. We looked at period and product costs. This is a key distinction in accounting. And we make judgments between whether we whether we expense the cost in a period or whether we allocate it to a product and it goes into being an asset until we sell that asset, the inventory, and then it becomes an expense, which might be maybe in the same period, but might be in a different period. And then we had a look at direct and indirect costs. Teo Bark divided the product costs into these two, direct and indirect. Direct costs, again, important concepts. Direct costs are those that clearly connect to a particular product or service. Everyone would agree that that is a cost of that product or service. Bart Simpson would know. But the indirect cost is, well, it's not so clear. And we've got to make some judgments. And then we introduced you to a couple of methods or approaches that we use in accounting to allocate direct and indirect costs and also just indirect costs to products or cost objects. We're focusing on products. All right, well, thank you very much, everyone. I look forward to working with you in the coming weeks as we focus on the important area and very interesting area of management accounting. So bye for now. Bye-bye.